All righty then. Welcome in, ladies and gentlemen. We just got back from eating fried chicken at Gus's famous fried chicken, where it will go through you like a bullet through styrofoam. So if we have to pause momentarily, y'all will know why. So we had a great discussion last night at the restaurant, and James here was telling us about how he's been doing. And if y'all remember, James went through the mentorship, and he's the first person that went through the mentorship that really was doing something other than the 1-1X trades that we do. He was doing iron condors, credit spreads on the put and debit side. So he's done a fabulous year. And here's where everybody was perked up. Nobody was listening to James. Everybody's like, oh, whatever. Here comes James talking about whatever. And then all of a sudden, we asked him how he was doing on the year, and he's like, well, I'm just up 15%. 15%. Hell, next thing you know, we all turn the chair. So we're going to all take our little notes today so that we can figure out what James is doing. And so, James, tell us what's going on with you. What about a little bit about your strategy?
All right, thank you, Bobby, and hello, everybody else. Wish you guys were here. Wish all of you were here. We're having a good time.
Isn't this fun?
This is a great place, and the venue has been great. And the meeting last night with Tom was great. And so, just looking forward to continuing this on. Just had a good meal, so we may get a little sleepy, but no. When I went through the mentorship, Bobby taught me a lot, and he taught me about myself. The 1-1-2, I think that is an excellent and great strategy. There's nothing wrong with it. I just was looking at something else and wanted to try it. And of course, nobody discouraged me from continuing to try those iron condors. So I developed a trading plan around that. And basically putting on 90 DTE iron condors, and we have evolved that from putting on both sides to sometimes making the put side a little bit heavier, just depending, so that we don't want to get caught flat-footed if the market is going to melt up. So learned a few things about how to try to manage and keep the needle centered, so to speak. But I will say that one caveat to this whole thing is I have not been tested. My trading plan says move out, manage at 30 delta on either side, 30 delta. But the market has not tested that yet. So everything that I'm going to say is without the level of experience that I probably should have since I started placing these trades first of the year. So we're a little over 4 months into this, and the market has moved basically sideways. So this is a perfect time for the iron condor. Although at the beginning, I was putting on at around the 3,800 in SPX, and it did move about 300 points to test the calls, but it never flushed me out. So that's yet to come. Now I fully expect to be tested. And then we will see again, we'll check again where the P&L stands, and I'll definitely be happy to share and report back once we get a true test on that.
Well, you said there wasn't a true test, but in my opinion, it was a really, it was a hard time on the call side, because you were like up $100,000 or $120,000 on the year. And the next thing you know, you're down $30,000 for the year or something like that nature. So it was a test, but I don't think it was the point that you were at management. But I mean, if it had moved a few more points, you were at a point where you were about to do some adjustments.
Yes, our trigger finger was moving, and we were ready to start managing, but it fell back in the pocket, and hasn't really moved out of range. And of course, when you're putting on basically in a daily or every other day basis, taking off and putting on, you're able to keep the strikes, your shorts kind of centered around the spot. And So right now, the range, it appears that the market's in some range that it hasn't made up its mind yet which way it wants to go. But I believe that once it does make up its mind, it's going somewhere and probably in a hurry, most likely. So we will see the other side of that.
So on the put side, tell us about how wide the spread is and the delta that you're selling.
On the put side, I'm selling the 10 to 11 delta. And depending on where the VIX is at, that will get me most of the time around 600 points from the spot down below the market. Most of the time, 500 to 600 points below the market. On the call side, I'm doing a 6 to 7 delta, and that will get me around 400 points above the market. So at all times, normally between our shorts, we're about 1,000 points between shorts. I started first of the year with an account that I had back tested the 100 wide. So the short and longs were 100 wide on either side. And then in the 1st of March, I decided to open another account and go with 150 wide. So I'm running both of those. And
What was the primary determination of making that change, James?
I saw that there was more premium that you could collect with the wider iron condor with wider spread. And it looked like there was some benefit or some efficiency that the buying power did not reduce so much that it was prohibitive. There was still buying power efficiency moving moving it further apart and more premium coming in. So just a matter of trying to be a little more efficient was an experiment with that was the main reason.
And we talked about 100 wide. I don't know if we mentioned this, but your primary trading vehicle is SPX.
SPX, correct.
And James has a portfolio margin in the account. I would say if someone that did not have portfolio margin and wanted to do something similar, they could probably do the exact same thing in the E-minis and take advantage of span margin.
Yes, correct.
Okay, so we're basically putting a trade on day one. And your goal with that is to let it go to a certain percentage of profit, or do you hold it for a certain number of days? What's kind of the plan with putting those on?
Yeah, so originally the plan I wrote was to go closest to 90 days with an entry and then harvest 30 days. And in theory, if the market didn't move at all and was static, then that would bring 50% profit in 30 days. But the market obviously does move. And so after watching it for a while, I decided to change the trading plan. And so I revised it to say that we want at least 50% profit, and we will accept however many days it takes to do that. And so between 30 and 40 days, normally we're able to bring the cash register on profit taking. Also, a change that I made to the original strategy was to go ahead and harvest independent, the call side independent of the put side. Because we were having days that the market would move 50 points, 60 points, 70 points. And we were hovering in that 30-day time period. And all of a sudden, you move up 50 points. The put side, it's getting time to harvest, and they're profitable, and allowing them to go even to 70%, No, we were harvesting it at 70% and then let the market move back down and fall back down and harvest some of the call side. So that started working out really well. But again, if market takes direction and sticks with that direction, then there's some modifications that will have to be made to this.
Okay, so let's make an assumption that you get challenged on, we'll just say the call side. What is a challenge? When is your trigger to adjust or to take some defensive measure?
We're challenged at the 30 delta. That's the line I've drawn in the sand. And so we can take and just remove the position. But there's a couple of things that's going to move that call side to the 30 delta. Well, the main thing would be probably price action would move that. So at that point in time, we would probably remove the position. And if the market was really moving strongly to the upside, probably would take off a lot of those positions and then just re-enter a position on the put side, buy some premium out further in time. And that's what I used to call rolling, but I don't see it as rolling anymore. I see it as abandoning a poor position and opening a new position further out in time and further away from the spot.
So you would close the losing call
Close the losing call,
and then reposition on the put side.
reposition on the put side if there seemed to be, if conditions were calling and it would appear that the market was going to continue to make that upward move. That's probably, and this could be correct or it could be incorrect. We'll discover and find out. The other option would be just simply take and close a position, the losing position, and then re-enter on the call side, further out in time.
So you said, if it appears that the market was going to continue in that direction, are you using any technical analysis? What are you using to make that determination?
I guess maybe a little sense of scope and flavor from all avenues. I don't want to get too biased in the market because it's just going to prove you wrong. But if there's clear signals that we're coming out from under some of the headwinds, and I think you can make some general assumptions that there's going to be the market's going to trend in an upward direction. Certain things happen. I don't have a particular technical indicator that I would rely on to tell me that, but.
And are you maintaining pretty much delta neutrality, or do you normally carry a little long deltas? How's that work?
At this point in time, I'm a little happier with negative delta. Not anything wild and crazy, but a room for the market to come down a little bit.
So to do so means you're a little heavier on the call side.
Not with more positions, but I'm closer to the spot, and I think just that action alone is going to give me negative deltas.
So a move up, as the market normally does, generally automatically gives you the negative delta. It's an inverse relationship to market movement.
Yes. So, and the idea there is that I think that I will have a better shot at catching the upward move than I would a move that is following.
When you say catch the upward move, you mean you will have time to
manage it. Yes.
It's not going to be a crash to the upside.
Right. Exactly. That's the thinking.
Okay. So when we were in the mentorship, you talked about different ways of hedging, different things. But I think what you ultimately came up with is that your trades, although they are wide spreads. They are defined risk trades, and I think your management is simply this: you are willing to take. I think your metrics are up to like a 25% loss on your entire net league. You assume that risk going in, so it's not that you buy insurance or do anything. You just assume that 25% of your entire account could go at any time.
Yes, so if there was something that was so devastating as to crash the market, then 25% is my max exposure in the market, and that's where my buying power sits. And even when the volume, we had the ball spike, the buying power did not go up because we had already defined our risk. So I used that time when that volume went up, I increased my risk metrics to say, you know what, we have rich premiums. And I believe I'm going to go ahead and sell some more premium and bump that buying power up to about 35%. And so I'll reassess my risk metrics at that point in time. And it just so happened that that actually worked out because we had kind of a ball crush afterwards, a few days or a week or two afterwards. And I was happy that I had made those premium levels or sold that premium.
So y'all, this is a really, really important distinction between what James is doing and those of us that have been in 112, where most of us were really hurt by what I call the Volmageddon in the middle of March. James was not hurt by that because the VIX increasing as it did not have the same effect on his portfolio because he is in defined risk trades. Ed was really like, that was one of the things Ed was like, oh my gosh, that's a really, really important distinction. And it's one that I think we all should keep in mind with this strategy, is that the VIX increase didn't hurt him as it hurts most of us because he's in a defined risk trade. Very important. So what else is there on this strategy? I mean, it's really simple. I wish everybody could see the way that James sets it up. He's in trading on the Tasty platform. And basically his deal is to keep the little flag. For those of you that know what the analysis tab kind of thing on Tasty looks like, his thing is to keep the flag in the center of his strikes on the puts and call. He really keeps it like, if you're looking at a football field, he's keeping it on the 50-yard line. And it's kind of a fun thing to watch. And if it starts going up one way toward the calls, then he is going to put more positions on the put side. If it starts going down to the put side, he's going to put more positions on the call side. And correct me if I'm wrong, but to get the thing rebalanced, whatever it is that he has to do. So it's just a brilliant strategy. He's doing well. And we were up almost 10% at that time back in March. But again, it was the volatility that took us down that didn't take James down at that time. Anything else about the strategy, James, you think of that we hadn't really discussed?
I will say that if you consider the 100 wide versus 150 wide, my experience with 150 wide, I entered 1st of March. So a little over 2 months, we have experimented with that. And that account is up 10% into.
And you started that account when?
1st of March.
Ed just ripped his trading plan and it's like, screw that. I'm not doing the SPX 150 wide. That's amazing though, Jason. I mean, it really is. And it's just such a simple strategy, y'all. He's doing both sides. We talked about the difficulty of the calls, but he has managed to work himself out of that. And it's been a phenomenal strategy. Anyone in the room got any questions from James at all? And then we'll let Ed kind of look at any online comments that we have. And I think we've got audio here too. If anybody listening online has got any questions, James, and would like to ask him, we certainly would entertain your questions. James is very nice and kind and very willing to share about his strategy.
Yeah, I've got one if nobody else does. Earlier on, you had said that your plan is to manage at 30 delta and your call side is about 400 points out of the money. But you also mentioned that we had a 300-point run up. So I'm just kind of confused how a 300-point run up when you're only 400 points out of the money didn't put you at a 30 delta.
Well, that 300-point run up didn't happen in 2 or 3 days. So that was kind of the first test that we had. We went from 3,800 to 3,850 to 39, and then up to, we were at 4,100 at some point in time before it retraced. But so the ability to begin putting on positions and following the market as it moved up. So I would keep in front of it. There were positions that had been put on, but at that point in time, I think I was a little fortunate in that the VIX was high enough that I don't think I was right at 400. Today I'm at 400 because to get that 6 or 7 delta, but back then the VIX was up in the 20s or low 20s. I think it was.
Okay, so you were further than 400 points out of the money at that point in time.
Right.
Currently, you're at about 400. That makes sense.
Correct. But it was close. We were at 30 delta for one day when I opened it up, and I decided that I was, I just was going to manage it the next day, and don't get lured into that. But that's just me. It pulled back on us. So I did let it touch.
Thanks, Evan. We wish you were here, Evan.
Yeah.
James, you're doing it.
It looks like a good time for sure.
Correct, Ken. 90 days.
Entering every day or
Every day until I get up to the 25% buying power. And at that point in time, I'll I kind of stop and wait till I harvest something and then put on a trade after we harvest.
Now, what about you use my spreadsheet? Do you track the theta and your deltas and all of that and your buying power on the spreadsheet?
I do, and it helps me to figure out what relationship I have with the metrics that are there. And after a while, you get a sense that you watch it every day, you enter it every day, and you start seeing how everything is correlated together. And that gives some level of psychological comfort to know that, things are riding in a normal progression. And the theta is one of the numbers that I look at a lot because I want to know what value is coming in. I also want to know, what would be a risk measure. It may not be the exact risk measure for this account because it's defined risk, but I want to know what risk measure it would be for any other type of account. I always want to be aware of that, and then be aware of the negative deltas to know that, hey, if the market goes up in the morning, I'm going to take a loss on this account. It won't be a real loss, but I will at least be aware of where it's traveling. If it comes down, those negative deltas are going to help me out. And so those are helpful for me to kind of be self-aware and have a situational awareness. And I use that.
So where we that are doing 1 and 2 kind of keep a minimum theta of 0.1, does that influence your decision at all? Can you kind of tell us where percentage wise your theta level stays?
Yeah, so that theta, now that number did move when the VIX was swollen, and it moved from like 0.10 to 0.16.
Okay.
And so I was aware of that. I was watching that, but generally as just observing how it moves, it's right in there in the 0.10 range.
Isn't it amazing how that kind of works? You know, that 0.1 is just such an important thing. And I mean, that's one of the things we got from Tasty, y'all, and it's, you know, regardless of what we're doing selling premium, keeping that 0.1 there is really kind of important. The advantage that he had, again, is we were up a similar percentage, or would be a similar percentage, but we were hurt by the big spike, which he did not have. I can't reiterate that enough. And that's the reason that he was able to now be at 15%, which is really, really, really cool. So any other questions?
I had a quick question. So, James, you said 400 points away, you go 400 points above and below the market to start?
Yeah, yes. So I'm really, I look at two things. I look at the 6-7 delta, and then I look to see how far is that? Because I like to be comfortable on both sides there. And if it's not far enough away, I may think about it. And really in these low VIX environments here, I'm monitoring this and seeing that, you know, the 6-7 delta just doesn't get you as far away as you might, we're comfortable with. So I may hit a happy medium in there somewhere, but I'm trying to be at least 400 points. And I was more than that at the beginning. But there's just a little comfort zone. It's a psychological thing for me.
But roughly 400 points is your comfort zone on the call side and 600 down on the.
Roughly, but I will probably let Delta maybe speak the loudest unless I find that Delta is bringing me in too close, 300 points on it, and then I may start changing my metrics.
What premium are you bringing in on the put side and the call side, 150 wide? About what are you bringing?
Right now, on a tranche of 10 contracts, you could expect about $15,000 premium. And if you want to, the idea is to harvest between 50 and 75%.
Other questions? I mean, it's a really simple strategy. It reminds me a lot of what Karen the Super Trader did, except she was doing strangles instead of this. But as we last talked to Karen, she is now back doing iron condors as well. And it wouldn't surprise me if she's doing something similar. I think her time frame though is like 14 days now. So she's taking that down. What made you think about, I mean, I know you did some back tests or some live testing. What made you choose 90 day?
Really, that came from just listening to the group and the experiments that were going on within the trader nerd community. And then just going and checking that. But the idea was that if you were far enough away, if you were far enough out of the money, that 90 DTE would give you 50% of the premium if everything was static in 30 days. And so I ran that, checked that, and I found that to be true. So I thought, well, 90 days then is probably the best spot then to get premium decay far enough away from the spot to have that premium decay of 50% in 30 days.
You know, we all look forward and go, well, if I had to make some changes or if I was going to tweak something, I'd do X. But I would imagine you are pretty comfortable where you're at. Do you foresee any additional changes to the strategy? I mean, you were doing some hedges and things of that nature, but it sounds like what you've done, and we hear this so often, the simpler I make it, the more effective it becomes.
So, yes, so I was doing a 7-day buying long put 7 days out and just reducing the buying power like crazy. But I found that that was an artificial thing, really. The buying power was being reduced artificially. And, I was really using that 7 day long to go and put more positions on. But as soon as we got close to expiration and I didn't re-enter position, or if the market moved and those longs started costing more and became prohibitive, either way, if I ever let those longs expire, buying power, jumped back up and told me that, hey, in reality, you have too many positions on. So I just experimented with that, but just found out that, hey, I'm basically giving myself something to feel better with, and when it really doesn't do what I had hoped that it was doing.
Any other questions from anyone online? Everybody's so quiet.
Hey, I'll
Okay,
just
I'll-
say, it's
Hey.
great to see your face here, James and Bobby, and y'all in the same room. I'm super jealous, but thanks for sharing your story with everybody here, James. It's been great to see you trade and, learn more about what you do, and it's impressive.
Well, and Bobby mentioned, what changes do I foresee, or do I foresee any changes? And I'm going to say, yes, I foresee changes, because I think as I gain experience in the market teaches me and tells me some things, I'm going to probably try to listen to it. And I know that's going to force me to make some changes and to do some things that I'm not doing today. So I fully expect for this to evolve to some degree.
Awesome.
I have another question. So I'm setting this thing up 400 points away, and I'm not getting a negative delta on it. I'm getting a slight positive delta. So if you need to adjust that, which side do you adjust typically to make that a slight negative delta?
Well, I'm just a little heavier on the put side, and it gives me. Well, I'll take that back. That would be the.
Put the calls closer to the one.
So I should be. What is that giving you today?
0.01, right?
If
Pretty
you
much
move
zero.
your foot a little closer to money, it'll probably turn.
Yeah, then it would turn into a little negative. A little bit closer.
No, I'd say put it to the foot closer.
What does a
You
6-2?
get more latitude on the sixth side of the support.
I just modeled it as well, and 97 days, and we're roughly 500 points away on the cold side. So 500 points on the cold side, and on the prediction on the put side, 151. Delta 1440 is negative 1.97 delta, positive 19.2 theta.
Okay.
And that's about it. So that apparently meets the conditions, but that's close to 90.
Right. So I think July 31st is my last trades that I've made, and I think they're down to 82 days or whatever. So I'm right at that break point where I'm gonna, I'm switching from 81 day or 82 or what the last, I think it's a couple of days ago I traded.
It's
So-
so good on here, right? On what you said.
Yeah.
Yeah, right, what exactly.
So when you move to a 97 or whatever, you're that's a lot of days.
Yeah.
So
So
you're-
6 to 90 days.
Right. Right. So you're getting a little bit of a different answer. So it's a general 400. And if it's 500, I'm happy to hear that, because the next my next move into the market will be a little further away.
I guess if I really adjusted it, then it's 80 days. Then
You'd have a little different answer.
And are you doing the opening order as an iron condor, or you can do the side step or single trade?
Well, that's what you're doing, right? Or you did long, yeah. Well, I started going in close to the same time period, but I don't enter as an iron condor. I enter as two separate spreads, and I track it as two separate spreads. And just recently, I've seen so much movement during the day, or there's always been that movement, but I'm just noticing it and saying, can I take advantage of that? Let's go ahead and put an order in, and let's increase what I'm going to sell, my sell price. And let's see if I don't, at one point in the day, I get more premium for the foot. At another part of the day, all of a sudden, the call comes through and I sell that. And I'm able to get maybe a 10 or 15 point advantage there.
On a portfolio margin, what is your buying power requirement per one spread?
The 10 tranche, the tranche of 10 contracts, I believe is around 50. It's either 50 or 60. I know on the 100 wide, I think it's like just under 50. And on the 150
So-
wide, I think it's around 60. I think I'd have to look.
So it will be somewhere in the neighborhood of 50% of your max loss, roughly.
That would be pretty close. Yeah.
So question would be, you say you're willing to risk 25%, and that you do that according to your buying power, but you're actually exposed to around 50%. Are you just counting on closing quickly if everything comes to actual loss of 25%?
No, well, so at 25% max risk, of course, on Tasty Trade, on their platform, I'm able to see what the risk is, and you've got the definition right there on either side of the iron condor. You can go down and see exactly, if you plug this in, you would be able to see, well, if the market went to zero, what is your loss? And if it went to infinity, what is your loss? And so where I'm at right now in my portfolio is I'm at about 25. Well, yeah, I'm at 25%.
Right. I guess my question is, are you looking at the 25% actual max loss, or are you basing it on a buying power which is less than your max loss?
Because I do, after sitting here thinking about that, there probably is some distinction there. But max loss is what I have in my mind, which relate that to buying power. For some reason, it seems like it's pretty close, but it may not be.
Right. Okay.
The idea is max loss to the portfolio is 25%.
And the good thing is with doing iron condors that you can only lose, well, you can lose on both sides, but simultaneously, you should only be losing on one side or the other.
Sounds like Victor, by the way.
Yeah.
Yeah, Victor's been a great addition to our group. So
Enjoy reading your stuff.
yeah.
Oh, I'm sorry. I didn't hear you. Did you say that you read it?
I've enjoyed your room. I have
Great. Thank you.
what you placed your content there. Thank you for contributing.
Thank you. Thank you. Pleasure.
Okay, other questions? Okay. Well, do we have one?
Hey, Bobby and James and crew. Can you hear me?
Yeah, you're great.
Actually, James, do you have a write-up of your plan that you discussed anywhere in our room?
I don't, and I was asked that when I was, did the little graduation thing, and I told everybody I would be fleshing it out and putting it, and I think that probably now, I just need to button it up and just, because I don't think it's gonna, unless we get some big market moves that tells me that there needs to be a big change, or we need to just scrap it. I think we're probably to a point where we just send it out, let everybody look at it. And
Yeah, I'm just curious because it's one thing to listen to the conversation today. It's another thing to take your time and read it and then see what questions it generates.
yes, so I think that we ought to do that when I get back to the office. first part of next week, I'll try to get it out and post it somewhere. I don't know what room we post that in, but
Well, we'll create your own room. How about
no,
that?
I don't want that, but I'll send it to Ed and I'll post it into Ed's room.
Got a trading plan here, but I'll get there. That's what.
Yeah.
Thank you. Look, so much, Glenn, that's Glenn right now. Glenn was also asking or answering someone's question, like they're having trouble with the mic and stuff, because he's like, you probably have to use ES. I mean, like the buying power need, I just set one of these up in ES at the 80 BTE. And it's only requesting $1,160 worth of buying power. Now that may change from
That's for a one truncher,
one
right?
account to another account, and that's in a non-IRA, yeah, it's for a one tranche of ES, not SPX.
I set up in that 25 and then you pay and it was 16,000.
Okay.
First was 150,000 on SPX. It's quite a bit less money. Yes, children find sort of.
It's a very interesting strategy. I mean, it really is.
Well, and it's an old strategy, really. I mean, that's the iron condor has been out for a long time. It's just messing with the wing size, I guess, in the long DT expiration.
And I think one of the problems for those of us that did iron condors the tasting tray way, I soon found out that iron condors don't work. And the reason that they don't work is because we're going, in SPY 3 or 5 wide, rather than doing something that has more characteristics of a strangle, which is what you're doing. But it does have defined risk, but it has a lot of the characteristics of a strangle. And I think that's why it's successful in your situation, rather than those that may be doing this in Apple or Tesla or something of that nature, and doing a 5 wide iron condor. This is 100 to 150 wide, so much more like a strangle. Okay, well, James, thank you for sharing with us, and everybody's excited now, and Ed's over there typing away, and he's asked for a cigarette lighter so he can burn his trading plan. So anyway, thank you so much, James. We appreciate it.
All right, thank you.